Retirees often wonder, do I need life insurance? Most young families don't have the financial assets to cover off things like monthly bills, mortgage payments, childcare, and the costs of caring for aging parents if one of the incomes in their household suddenly disappears due to a premature death. But what about retirees? Their income in the traditional sense no longer needs to be protected since they're retired. What should they do with life insurance policies that they've been holding on to? Should they let them go? Should they keep them? Or should they be purchasing even more life insurance in retirement? In today's video, I'm going to briefly outline the different types of life insurance, why life insurance is sometimes misused, good reasons for retirees to hold on to life insurance policies, and some not so good reasons that people hold on to life insurance in retirement. And if we haven't met yet, my name is Mark Walhout. I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. Now we'll spend some time talking about the different types of life insurance. And for young families, overwhelmingly, their biggest financial risk is the loss of an income. And for this purpose, term life insurance is the most appropriate product. You can lock in a premium for a fixed number of years. At the end of your term, you have the choice to pay either a higher guaranteed renewal amount, reapply for new insurance if you're in good health, or let the policy go for nothing if the need no longer exists for the life insurance policy. You can think of this as similar to the way that you consume house insurance or car insurance. Life insurance needs can be quantified using a couple of different methods. First is the income approach, and we'll use an example. Let's assume we have a 45-year-old working couple that seeks to replace $7,000 of after-tax monthly income in the event that one member of the spouse couple passes away, and they want that income to continue for 20 years. That will take them to their projected retirement date of age 65. Assuming a 5% rate of return and 2% annual inflation, that would require that they take out a term life insurance policy worth about $1,250,000. Assuming that both members of the couple are in good health, they can expect to pay roughly $170 per month for male to purchase a $1.25 million 20-year term life insurance policy, and a female could expect to pay about $120 per month for that same $1.25 million 20-year term life insurance policy. The other method that the couple could use is a capital needs approach. And this approach to sizing life insurance requirements is you simply look at the obligations that you would want to have taken care of in the event that you passed away and focus the life insurance on addressing that specific need. This approach might be used if the surviving spouse's income is sufficient to cover monthly household expenses after the capital needs have been taken care of by the life insurance payout. So a capital needs analysis might look at paying off things like the mortgage, pay for kids' education, or may take into account the present value of future savings that might be required to pay for the retirement of the surviving spouse. The next type of life insurance that we'll review today is permanent insurance, which has a number of different variations, including whole life insurance, participating whole life, universal life, limited pay whole life. Each of these variations have different premium structures, and some have an investment component that is tied into them. But generally, the best use of permanent insurance is for a future liability that you know for sure you will have to pay when you die that cannot otherwise be funded from other sources. And things that come to mind here are potentially a large tax bill that might arise on the transfer of a cottage to your children when the second member of a couple passes away. Another reason might be creating liquidity for your estate. Say if you own a lot of assets that will be hard to dispose of when you pass away, but your estate will need cash quickly to support a surviving spouse in their old age while the estate is being dealt with. There might also be some very specific tax planning situations. You might have a privately held corporation that has a large amount of assets inside of it that might create a tax situation when you pass away that might be well addressed with a permanent life insurance policy. Permanent life insurance premiums are significantly more expensive than equivalent amounts of coverage of term insurance. And the reason for this is the life insurance company is guaranteed to have to pay out the life insurance policy when you die, because once again, it's not limited to a specific term. It's going to pay out as long as the policy stays in force when you pass away, whether it's sooner or later. A term policy, on the other hand, only pays out if you die within the term of the policy. If you keep your term policy, the premiums on it will go up significantly at renewal time. It's cheap for young and healthy people because the likelihood that the insurance company will need to pay out that policy for our example couple of 45-year-old inside of that 20-year time horizon is very remote. Some round numbers for comparison purposes. if this 45-year-old couple wanted to take out $1.25 million of insurance coverage and decided instead of getting term insurance that they wanted to get permanent insurance, the cost for a 45-year-old male for a $1.25 million whole life guaranteed life pay policy is $1,300 per month approximately, or 7 times the equivalent of a 20-year term life insurance policy. And for a 45-year-old female, the costs on the same policy would be $1,150 per month, or 9 times the equivalent of a 20-year term life insurance policy. So why does insurance get a bad rap? And I think that oftentimes insurance is looked at negatively because generally people are sold the wrong product used at the wrong time for the wrong need or for a need that doesn't exist. For our example couple who needs $1.25 million of income replacement insurance, term is clearly the better choice for them. It suits their need perfectly. But if they end up getting sold a whole life policy that costs between 7 and 9 times more than the term equivalent, they have a right reason to feel frustrated by that. The unfortunate case is that insurance advisors are paid significantly more when they place a whole life policy than when they place a term life policy. The commissions on a whole life policy in our example would be 7 to 9 times more than the commissions on the equivalent term policy, which is what this client in our example couple probably needs. So when does a retiree or someone who's approaching retirement no longer need life insurance? And the answer is when that person or those individuals no longer have obligations that will not be met when they pass away. So for example, a retiree couple who has no mortgage, who has a fully funded retirement, or maybe they're working for leisure, they have no specific legacy or bequest motives when they pass away, or they're not going to have a massive liquidity need when they pass away. To me, those people typically don't need life insurance. So when they're approaching retirement and looking at that policy, trying to decide what to do with it, they may consider letting it go. But there may be good reasons to hold on to at least some life insurance as you move through retirement. And it is if somebody will encounter issues with income when their spouse passes away. So it's possible that some expenses in the household will drop when that first spouse passes away. Potentially food costs will go down, clothing costs will go down, personal items, maybe gas for the car, vacation costs may go down. But a lot of household expenses won't change when the first member of a couple's spouse passes away. Things like property taxes, utilities, home maintenance. And if the survivor plans to stay in their home when the first member of the couple passes away, the impact to their finances might be severe because there are certain income streams in retirement that will diminish when one member of the couple passes away. We'll start with old age security. The old age security benefit is 100% lost when the first member of the couple passes away. For a pensioner who is between 65 years old and 75 years old, this means an immediate loss of $715 per month of retirement income. Canada Pension Plan will be partially lost. Canada Pension Plan does pay a survivor benefit to surviving spouses, but the amount of the survivor benefit will certainly not be 100% of the deceased spouse entitlement. So there could be a loss of several $100s per month or more on the passing of the first spouse in CPP benefits. And if the deceased spouse had a private pension or they had an annuity, it's possible that between 40% and up to 100% of that benefit could be lost, and that could mean even more retirement income is lost for that couple. There are situations, though, where a couple should think twice about holding on to their life insurance policies in retirement. Take, for example, a retiree couple who have more than enough money to live comfortably throughout their retirement. Their financial planner ran a scenario demonstrating the impact on the survivor's retirement income when the first member of the couple passed away, and the plan was satisfactory to both members of the couple. The only tax bill being projected on the second death at age 95 comes from the deemed disposition of the full value of their RIF accounts. The gains on their house will not be taxed as they will be sheltered by the principal residence exemption. The house can be sold by the estate to raise funds to pay the RIF tax bill. The trustees will have at minimum 6 months from the date of death to come up with the funds. For this couple in this scenario, they might consider letting their life insurance policy go and directing those dollars elsewhere. In closing, retirees who no longer have obligations that will not be met when they pass away can consider letting go of their life insurance policies. Of course, they should meet with their financial planner and have a robust conversation about the impact of a death on their retirement income before making this decision. Surviving spouses who will encounter a drop in their retirement incomes from the loss of a deceased's old age security, CPP benefits, and potentially private pension or annuity income, and who are not willing to make other changes, downsizing their home, for example, if they own a home, or reducing their spending if they rent, those individuals should consider running this scenario through their financial plan and determining how much life insurance they should preserve as they enter retirement. On the other hand, a rational person may decide that even though they no longer need life insurance when they're financially independent, that they still see a benefit that is worth paying the price to hold on to the insurance policy, which include the immediate liquidity of a life insurance policy when the deceased passes away, and the flexibility of those dollars, the ability to name multiple beneficiaries, the bypassing of those proceeds around their estate. Those are benefits that some people may want to preserve even though they technically no longer need the life insurance policy. So do retirees need life insurance in retirement? The big answer is it depends. Every circumstance should be judged based on its own unique merits, preferably through the lens of a financial plan. And if you don't have a financial planner and are looking for a second opinion on your situation, I've included my email in the description section as well as a link to book a time in my calendar. Feel free to reach out. Thanks for watching this video all the way to the end. If you liked it, give it a thumbs up. Leave me any questions or comments below. Make sure to hit the like button and the subscribe button and hit the bell icon so you're alerted when new videos are posted. Thanks again for watching, and I'll speak with you soon. Take care.